Sam was very kindly said that we are the pioneers of venture debt. I must add that in Southeast Asia, maybe, most certainly we are the pioneers there when we started our journey in 2015, when I was a banker before then. Um, Venture debt is a very, very mature asset class in the US. So there are many, many giants there. The famous one being Silicon Valley Bank, Hercules Technology Growth Capital, there's Triple Point, and many, many other smaller um, funds as well as financial institutions that provide venture debt. So before venture debt came to Southeast Asia, a lot of founders like yourself, I think generally only had one form of capital when going out for fundraise. So that would be in the form of equity, whether it is from like what people say, right? Friends, family, or fools. And then once you get past that stage, then you get to the VC realm where when you're raising your first institutional fundraising round. I saw a lot of questions that Sam showed me, very, very enthusiastic crowd, and I think, those would form a very good basis for the next hour or so.
Yeah. So maybe before we start and on that, you want to give us a little bit of understanding a bit more about alternative financing in the Singapore landscape.
Right. So venture debt, I wouldn't, well, it is an alternative asset class, but I wouldn't say it's an alternative to VC
Yeah.
money, which is the equity money. So we only provide venture debt to companies that have VCs on their cap table, raise a fresh round of funding from these VCs. Then we are able to kind of structure it in a way where what we are providing to the entrepreneurs is more money that's slightly less dilutive, or helping the company become more capital efficient. So you imagine today you are a company that you know sell something. You need to manufacture something and sell it on, whether it's online, whether it's an IoT device. You need to manufacture something before you sell it. So you probably have to either go to China, India, or wherever the factory is, and pay a certain amount upfront and get those gadgets, those items manufactured. So one check that you have to write to the contract manufacturers, and then you wait 30 days for the manufacturing, you wait another 10 days for it to be shipped to you, and then you sell it online. Before you know it, right, your money probably takes like 45 days, 50 days before you get back your initial capital plus profits. And if you are doing well, you're growing 20% month on month, suddenly you find yourself um, uh, doing very well, but running out of cash.
Mm.
Then the dilemma would be, do I raise another 5 million in a Series A extension to fund this working capital need? But if I go to the bank is not going to lend me because I'm loss making, and I don't have a 3-year track record. So that's where venture debt comes in. We're almost like the de facto banker for the VC backed startups.
Yep. Exactly. So what happens that you really have to, kind of use it as an alternative means, but it's used complementarily with the VC startups. In fact, one of the key things or the uniqueness of your fund is that usually you will prefer to have a VC to back you first, but you are here to leverage on whatever that is there, right?
Correct. So again, we are taking a lot of risks as well, to provide loan to a young and loss-making company. So typically, when loss-making, we need to look at sources of cash for repayment,
Yeah.
and part of it would come from cash flows generated from operations, but the
Yep.
other part would have to come from the VC's equity infusion.
I see. But of course, one of the key thing is, I think there is someone who was asking this question: what makes a venture debt more attractive to other forms of financing available in the market?
Well, you as a founder, actually, well, most SMEs, and the
Yep.
large corporates, MNCs, listed companies, they all take some form of leverage because it improves your return on equity.
Mm-hmm.
Equity is a very, very expensive financing tool.
Mm-hmm.
So if you ask me, why is venture debt more attractive? And it's because if you can get um, more capital that costs less,
Mm-hmm.
then that's where the usage that's where venture debt is very, very beneficial.
Mm-hmm.
Yeah.
Yeah, in fact, that is one of the key thing, right? Because you end up owning more parts of your company and you are just leveraging on your debt so that you are able to get a cash flow, but at the same time, valuation of company will probably go up if it's managed and you take the right bets along the way.
Yeah, correct. So if you use venture debt wisely, structure it wisely such that it gives you a meaningful cash runway extension, whether
Yep.
it's by 4 months or 6 months, and it's slightly actually it's less dilutive. Yes, you do have to give. We do take equity warrants, but we never more than 1-2%
Yep.
of the cap table. So it's still very, very capital efficient. We take we provide you that extra 4 to 5 months of cash runway extension,
Yep.
such that that hey, actually in by month 2, month 3, I can launch a new product, go into a new geography, and that improves my valuation at the next
Yep.
round. When there's that big valuation uplift or bigger valuation uplift, you tend to see there's lower dilution as well.
Yeah, true. But of course, a question from Gal actually for her is one of the question is that when does venture debt work and when does it not work? And why do you usually tag it to venture capital?
Why do we tag it to venture capital? So I'll take the last question first. We tag it because the company is young, loss
Yep.
making. There's no profits. There's really little in terms of reserves,
Mm-hmm.
and hence we need to look at the new investors pumping in cash, and that really forms the basis of us lending. When is it good? If you have receiveables,
Mm-hmm.
you have working capital needs, and you are trying to fund for growth, i.e., you're fun you've got a few contracts or a few um, things to sell, that it kind of like, if you sell it, you're going to make that 30-40% gross margins.
Yep.
Then why should you in a way share the upside with an equity investor, right?
Of
So
course. Of
you
course.
don't so you raise enough. I'm not saying not to raise, but you raise enough for the moonshot projects,
Yep.
the R&D, the new product development and all that. But if you've got contracts, especially like, I mean, the example I can give you is the B2B, right? Like,
Yep.
that if you execute it well, it's
Mm-hmm.
just a matter of time that you get your money back.
True.
Yeah.
It's just
So
that
those,
certain companies itself take forever to pay you, right? Especially when they are startup and all. Well, a
yeah.
contractor might be 3 months, but sometimes they might take 9 months to pay you.
Exactly. So the other beautiful thing about venture debt is a lot of founders raise it as an insurance policy
Okay.
buffer, right? So
Yep.
if I've raised 10 million in equity, nothing's to stop me from raising $2 million of venture debt, and I structure it well, and it gives me meaningful cash runway. I may or may not use it. I may
Yep.
or may not need to use that full 12 million, but it's there if I need to.
True.
So it's a really good form of insurance, especially with COVID now. Who
You
knows?
never know, right?
Sometimes the an equity round takes 2 to 3 months longer to close, right?
Yep.
So at least you've got that lifeline in the form of venture debt there.
Understand.
So
Understand.
when is it not good?
Mm-hmm.
When is it not suitable
Yep.
for? When is a company not suitable for venture debt? Is, I'd say, high, very, very high burn relative to the development, the
Mm-hmm.
stage of the company, and
Okay.
companies where there are negative gross margins. So really, there's a lot of subsidy. There's a lot of very, very thin margins where there's just no visibility on debt repayment.
Yep.
Yeah, so those are the companies that are really not ready for venture debt.
So I guess companies like really companies that has a foreseeable route to profitability, cash flows coming in, revenue coming in. But
Yeah.
of course, that actually packs very nicely to the question from Andy. Andy runs IES in class incubator, and you're asking whether venture debt is suitable for pre-revenue companies. So I
Uh,
think it's kind of similar on that aspect, right? Because you are saying heavy upfront. But do you actually invest in pre-revenue company as well? Do you take that in consideration?
no, I mean if we invested in a pre-revenue company, then it's really we might as well just call ourselves a VC, a seed
That's
VC.
true.
Right? But having said that, again, it's really never say never. In
Yep.
the US, the venture lenders would lend to the biotech companies without a dollar of revenue.
Oh, serious?
But
Okay.
but that's really how mature the market is over there.
Yep. True.
So maybe one fine day I'll be sitting here with you 5 years later and say, hey, we just invested in a pre-revenue company and we feel really good about it.
Well, you never know, right? Because
Yeah.
maybe that's where the maturity of your LPs and all they are looking for this kind of investments at the end
Or
of
the
the day.
market, yeah, you know.
Yeah. Correct, that's true. But of course, I know that you do a lot of venture debt itself. But of course, that's a question from Gary Teo over here. It's more from the point of view that, should revenue-based financing also be considered in situations like this, as well when it comes to, those with high revenue growth. Considering that usually a lot of times, revenue-based financing, even venture debt, are usually of a much higher interest rate compared to what you see in a bank, right? About 2 to 2.5% effective at this moment.
Yeah. So again, I would say the devil is always in the details.
Yep.
So we have looked at revenue-based financing. I think it's great. It's great for a certain profile of companies, but you got to also work out the effective IRR one is paying on those forms of financing. So in the world of finance, it's always risk-return trade-off, right?
True.
You mentioned the banks offering 2.5, 2%. Again, what are you giving up for that, right? I
Yes.
believe they are asking for a form of collateral, cash,
Yep.
direct guarantees, and stuff like that. So venture debt in its purest form, we don't take personal guarantees or
Yep.
I mean, which is why we look for certain other criteria. We
Mm.
look at certain other criteria.
Of course, of
Yeah,
course.
and
Yeah,
and,
of
and
course.
the, what
Mm.
we charge really is, I would say, a really balanced risk return, risk risk weighted return.
Yep. Of course, when I say balance risk return, I know I'm jumping a gun a little bit, but I know that there's a Sharish actually asked this question. What is your typical interest rate looking like in the range itself? Is there something
Well,
that comfortable to share?
I mean, it's not cheap.
Yep.
It's not cheap, but it's not over the top. I would say we are somewhere in between, where the banks would
Mm-hmm.
charge an SME
Yep.
and where the peer-to-peer lenders are charging SME. So we are kind of in between there.
I see. I
Yeah.
see. But of course, I hear you that, as a venture debt, that the ones that you provide, you usually do not take up, kind of any collateral or personal guarantee on that front. But of course, there's a question from Shamin from QuickDesk. Basically, she's asking, what are the risks involved when it comes to venture financing,
Right.
especially when it comes to venture debt over here?
Okay. So the risk, again, which is why you go back to a few minutes ago, right? The type of companies that would suit venture debt, sustainable business model, good unit economics,
Yep.
good margins, etc., because the debt is repayable.
Yep.
So that when you borrow, you got a return. So there has to be some cash flow visibility, whether it's from cash flow from operations or just cash sitting in the balance sheet.
Yep.
So that's one. The risk is a company is not able to service the loans. That's when they get into all these default and liquidation kind of
Situations.
issues. Yeah.
Yeah, that's true. That's true. But of course, besides venture debt and all, since you are in the ecosystem in space, I think Munchun was asking a little bit more from the point of view that what other options do they have, as a startup founder, besides venture capital or besides venture debt, or even what other options they might have in terms of financing?
Well, I've met a couple of really outstanding startup companies
Okay.
that are bootstrapped. So,
Okay.
they raise money from friends, family, and fools and never had to raise again.
So
And
it's
then,
just run out and that's it.
yeah, but as they grew to the point where, hey, look, there's only so much that our internal cash resources can take us.
Mm-hmm.
Sure, we can grow, but it will take longer. But if you want to grow faster, then we'll need to think about having whether the VC or the private equity investors come in. So it's really that either this or that, right? Of course, you can so-called rely on some government grants, but it's not going to be sizable enough to fund most startups.
Yeah, true. But of course, I do know of, I do know of a startup that basically was saying that government grants and all is also a form of financing. That's why when, it's how liberal they are or
It
how,
is, yeah,
they have a lot of support schemes for companies,
correct,
and that can be viewed as a form of, getting some form of funding for their
correct.
business as well.
And I'll tell everyone who's attending, right, that for us we are entrepreneurs as well. I mean,
Yeah.
the Singapore government is extremely supportive
Mm-hmm.
to entrepreneurs, especially during this COVID period.
Yeah.
And everyone should go hunt down all the grants, apply for it, make sure you get it, because it is there. The support is there. You
Yeah.
should take it. I mean, every dollar counts, really.
Yeah, completely. And I know that Yan Ling is on the call. I saw her over there on the list of it. Yan Ling's from ACE. So of course, if anyone needs interns and everything, ACE is the one to go for. They have
Yeah.
subsidies for interns as well.
Yeah, we are, really, like, we are all in this together, right? And
Yeah.
the government has really stepped up and done a lot of things. Even like you talk about interns, I'm sure I believe there are grants for hiring interns, as well as that SG traineeship and all that.
Yeah.
You just never know the kind of talent that is out there who are willing to take take a chance on this
Yeah.
1 year traineeship.
Definitely.
Yeah.
And I think the 1 year traineeship are fantastic, and it's also a way for us to kind of work on the cash flow side of it. But of course, it's not mutually exclusive, because during this period of crisis, one of the consideration is cash in bank. That's the most important. And like you earlier mentioned, it's all about the insurance, because there's a lot of uncertainty moving ahead as well.
Right.
But of course, on the question on COVID itself, I realized that in the last few webinars, you won't run away from the whole COVID world itself. There's someone who asked a question about COVID. Basically, the question is this: how will you see debt financing and project financing change post-COVID?
Well, we are not in post-COVID now, right? So I always say the
That's true.
Genesis narrative is life with COVID.
Yeah.
So for us, we see it as becoming even more important,
Mm-hmm.
especially for companies that, again, they need that form of working capital. They need,
Mm-hmm.
they have a sustainable business model.
Yeah.
I think debt financing has become even more important as a complementary form of capital.
Yeah.
Yeah.
True. Anyway, for those of you who just got in, I apologize that the streaming or the server was a little bit not too sure what's the issue around it. It's a bit slow. I know that some of you were stuck outside in the waiting room for quite a while, so I apologize for that. But in the meantime, also these are some of the questions that some of you have posted during the registration. But if you have any questions or any follow-up questions they might have, there's a button at the bottom for Q&A. So feel free to post any new questions they might have over here as well. Yep. So I think we have spoke a little bit about what are the considerations, what are pros and cons, when you should consider consider basically venture debt itself. I think there's a very broad kind of curiosity going around also about what are the terms around it. So I jumped the gun a little bit, talk about interest rate. We talk about it being in between of what you will lend to SMEs and what the likes of the funding society and all your P2P lenders are doing. But what is your typical terms in terms of a venture debt arrangement? What are the key things that you would probably have in your kind of term sheet itself?
Term sheet. Right. Okay. So for the vanilla venture debt, like let's think of a term loan.
Yep.
So we typically charge an upfront fee. There is an interest rate component, and then there is a warrant component.
Yep.
So those are the three main things in terms of economics, right? And then there's all the do's and don'ts, right?
Yep.
We look out for cash covenants, performance covenants, and a few other things there. But what we pride ourselves on doing is that the term sheet, it is all upfront. if you need explanation, I mean, we even work out the repayment schedules, so that it's not ambiguous. So we,
Yep.
especially for the less seasoned entrepreneurs, we make sure we handhold them. I mean, venture debt in itself, right, a term loan is no different from a mortgage loan,
True.
but we try not to make it too overly complex and really just walk through how it's supposed to work. And it's not, at the end of the day, it's not just about lending money. It's about building long lasting relationship with the founders. And to that extent, Genesis also prides itself on being a value added investor, not
Yep.
just about lending money and making sure you return it to me every month,
Okay.
but saying how can we help you, how can we help you to achieve your goals, how can we help you to get to your series B, whether
Mm-hmm.
it's extended business, third party business development, or a soft sounding to a pool of new investors, or making introductions and whatnot. you
Yep.
know we get quite involved in those things.
Mm. I see. So you have a pretty much very strong value creation mindset as well. To partner these, kind of companies that you finance.
That's right, yeah.
Yeah. You want to give a bit of an example of how you do that usually? Because this is something that a lot of VCs has been going out to a lot of staffs and all this talk about value creation, what are the benefits around it. So in your view itself, what are the key things that potentially teams like yourself or people like yourself is able to value add or value create on behalf of the startups?
Well, I mean, firstly, it's not really a black art or something
Of course.
mystical, right? It's really about looking at your portfolio company
Yep.
and talking to the founders and really understanding what keeps you up awake, what keeps you
Yep.
awake, right?
Yep.
Really, I think we've been blessed. We've got a very experienced team.
Mm-hmm.
We're very familiar with the equity and debt investment side of
Yep.
things. We have my managing partner is a PhD, and
Wow.
and the other partner has really strong operational background, and I'm just the boring banker, private equity guy. So when you
Oh,
put
come
all
on.
these minds together, I think there's quite a bit of network there, quite a bit of shared knowledge.
Yeah.
So again, when I look at it's really about taking a personal interest in these companies. So I give you an example in one of the earlier webinars I did on prop tech. So we
Okay.
invested in this company called Matterport. So they do 3D digital imaging
Okay.
for internal spaces.
Okay.
And they came Southeast Asia. I saw that they were doing a lot of things in property and all that. And we've got two other investments in one in the co-working space, Go Work, the other one co-living space, Hamlet.
Okay.
It's just like looking at portfolio. Yeah, we should introduce Matterport to these two guys. And
Yeah.
simple things like that,
True.
just having that commercial sense. And I think at the end of the day, it's really taking that personal interest and little bit of sense there, and say I think maybe these two guys should meet, and then you let it see how it goes from there.
Understand,
Yeah,
understand. But I do see some. Okay, so I think that is basically one of the areas of value adding. It's really about network. It's really about you remembering them along the way because you believe because your interests are aligned as well at the end of the day, and hence there's a greater interest to value add and to help them to be successful.
that's right.
Yeah, but of course, there's another question. I think there's some confusion over here. I think someone over here actually confused the difference between safe note and a keys note versus venture debt.
I,
So maybe you want to explain a little bit of what's the difference on that front, because to them maybe venture debt they are thinking there's a safe note or a keys note at the end of the day.
we are none of the above. In
Yeah,
fact, I think the safe and keys are much earlier on.
yeah.
uh did I I actually did a case study on that, but I've returned it really after I made the presentation.
Okay.
But venture debt, so it's actually very common. A lot of folks mistake venture debt for convertible note or convertible bond. In fact, we're not even that. We are really, if you think about it, we are really a term loan with
Mm-hmm.
some equity kicker, some warrants on the side. So let's say we put out $1 million in venture debt, that amount has to be repaid. There's no conversion on that amount at all.
Mm-hmm.
The only thing that we would convert, if we do, would be the equity warrant.
Mm-hmm.
So it's really different. Yeah.
So maybe for the benefit of those in the call and maybe they might not be so familiar with it, you want to explain a little bit more about what warrants are?
Right, sure. So warrants are hopefully our founders attending today are familiar with ESOPs, stock options. So warrants are a form of options that are issued by the company. So you could issue a warrant that allows you to buy X number of shares with the exercise price
Mm-hmm.
at say Series A valuation. So you know you have $100,000 warrant that
Yep.
with the exercise price at say $1,000,
Mm-hmm.
right? Then that gets you 100 shares.
Yep.
So that's how it works. And then
So
you know,
essentially, it's almost like your stock options. Basically, is that they are subscribing to a small part of the shares, assuming that you will be successful at hitting a certain valuation.
correct.
But but what you do usually as a venture debt itself is a very small proportion compared to you giving up a bigger equity for the same amount that you're getting into the company, and
That's
that's the
right.
proposition that you have.
That's right.
Yeah. Okay, I think there's one question here that's more related to a particular company. I think Harry was asking, he was saying that his company Buy to Sell Vietnam, as he said, it is no longer a startup. I think it's more of a scale up at this moment. There are 5 offices, 3 countries, 90 plus staff, 100% probably owned, profitable, no debt at all.
Right.
What would be the best move for their fast expansion?
What would be the best move? I'm assuming they have a expansion plan already. So I guess the next thing is to look at how you budget for it, right? How much do you need?
Yep,
5 million, 10 million? Do you want to fund it with equity
yep,
or some other forms of financing?
yep,
And if you think you want to go down that financing path, then have you spoken to the banks? How much are they willing to fund you?
yep.
If not, a venture lender would a venture lender have appetite for such a business or not? So you need to explore your options. I mean, same thing, right? Sources and users of funds, and then with that amount of so if you are telling your funders, if I have 5 million, I can grow the business by 10x.
Yep.
Then you allow them to do the due diligence and form their conclusion.
Correct. And I think totally agree on that because it's really about knowing how fast you're going to grow. And based on the pace of growth itself, you find out what's the funding gap. Then from there itself, you figure out exactly how do you get this source of funding.
That's right.
Yeah. Okay, and a slightly related question, but not so similar. This in this situation is actually a question from Ashar, basically, is that they themselves, specific to the company, they are established business, and also a startup at the same time. So I'm not sure how exactly. I suspect it's because they have an established business that's ongoing, but they
Right.
kind of have another kind
Maybe
of
a
offshoot.
subsidiary or something.
Yeah, basically go in the tech business or some form along that line.
Right.
Question is, what's the best approach to raise funds for such entity, or do they raise for both in the first place?
Well, without enough detail, it's hard to say, right? But I
Yep.
guess I would look at the mothership first and look at the performance and how much resources they have and what's the cash need first, right? If
Yep.
you're telling me the mothership is self-sustaining, it's profitable, then my next question is, why don't you fund the subsidiary, right? If you are
That's true.
sure that the subsidiary is onto a good thing, then you should try to keep the upside for yourself. Because again, when you are self-sustaining, you are profitable,
Mm-hmm.
and you're not funding your subsidiary, and you get the subsidiary guys to go out and raise money from third party.
Yep.
Sometimes it raises a red flag, right? Like, hey, how come your parent company is super profitable, they've got the resources, they're not supporting you at all? Yeah.
But that being said, it might be a different form of business, and in any startups itself, it's all about experiments, and it's a risk involved, right? So it's also a little bit of sharing of risk
Yeah.
with people who are willing to do it.
Yeah, if it's sharing of risk, then it's fine. But then it's always like I said, it's always in the details. How much risk are you taking, right? If it's a case of like, hey, I'm only putting 5% of the money in there, like the rest is 95%. Then you got to have that story. Why is it like that?
True, true, true.
Yeah.
And maybe this question actually comes from me, basically, just to pick your mind since you're on this topic, I did quite a few clients of mine that basically deals in the whole traditional to tech kind of business,
Sure.
and we have a few of them in that space. They have a traditional business that is doing well, but of course margins are normal, not hyper growth. But of course, with the whole theme of digitalization and all, they started to move and to dabble into the tech aspect of the business.
Right.
Question now is that while the tech development might be developed within this entity itself, they are open to spin off a new entity. So how will you view such a thing? Is that will you even invest in structures like this in this new entity itself?
Well, I would say never.
Yep.
You know, sometimes it looks and feels in a way, but when get to know the founders, you get to know why they're embarking on a certain path, you hear a different story. So, we never outright reject any company just because, oh, based on what you told me, I think it's not something we look at. I mean, we'll talk and try to find out more.
Yep.
Yeah,
Correct. So essentially, I think at the end of the day, it's still pretty much on a case by case basis. And I think one of the most important part at the end of the day is that the traditional business have to be self-sustaining.
exactly. Yeah.
Yeah, if
But,
not,
having said that, they are called a traditional business for a reason, right?
that's true.
Yeah.
Yeah. But because that is where a lot of kind of second generation business owners always have this aspiration.
Yeah.
They have a father and mother with a traditional business, went in the business, want to digitalize something, and decide want to be a bit of offshoot, but still want papa mama's money and support.
Yeah.
So they started off within the organization, but eventually you want to kind of shift out of the organization themselves.
Yeah, actually interesting you bring that up, right?
Yep.
Those founders have very, very good profile. I mean, they
Okay.
have a founder's entrepreneur DNA there.
Okay.
And I would think that they didn't wake up. They didn't wake up. They say, hey, I want to be a founder.
True.
A lot of them they say, hey, I've looked at my parents' business.
Yep.
It is inefficient, and these are the few things with technology that I can fix. Those are
Mm.
very exciting situations, especially if there is, it is a big problem and there is a potential for scale.
Yep. Understand, understand. And of course, when you talk about scaling and everything, I think one of the key important point for, I believe you will agree with me that when you talk about venture funding, it's not about venture funding for that, not about venture funding for whatever cash flow that you had in the past, but it's money that is placed in the growth aspect of the business. So a
Yes,
very strong point is about how you prove that there is growth, there is skill in whatever you are doing.
correct, correct.
Yep. Okay, there's a question here from Milan from IBS. I think they are Series A plus kind of company. And I think Andy also asked the same question on that fund. What is the minimum criteria to qualify for debt financing? But I think debt financing, I suppose, is a very broad field. Maybe let's go more targeted. What is the criteria before it qualifies for you to have a look at them?
For venture debt specifically, right?
Yeah.
I guess say a Series A company, few of the I say hygiene factor would be we definitely need a VC investor coming in. So I assume the company raises a Series A from the well-known VCs on the
Yep.
street. You raise $3 to $4 million.
Yep.
There is proven revenues, so you've got real customers. You've got revenues with decent gross margins. We understand how you're spending money. Hopefully the variable operating expenses are higher than the fixed ones. There's no factories, there's no aeroplanes and things like that. And then we try to say, hey, look, this business model, where does it fit into the world now?
Yep.
If today a founder comes to me at Series A and tries to convince me that we are going to build another ride hailing company,
Mm.
I'm like, really, like, you're probably going to waste a lot of money, right?
Yep.
Because so-called the giants are there, war is over.
Mm.
But there are a lot of other interesting um, business models that are solving real issues.
Yep.
We'll look at it. So those are the things that we look out for. And uh, founders as well, right? Like reputation. Do you have that tenacity? Do you have integrity? We
Yep.
look for all these things. The VCs, can we get along well? Is there chemistry, right? So at the end of the day, it's not just about writing the check. But
Yep.
if I can't stand sitting with you for more than 5 minutes, even if you have the best company, it's going to make that long-term relationship very, very painful.
True.
So that chemistry between us as venture lenders, you as the founder, as well as your VC investors, we got to be able to sit down and have a glass of wine anytime.
True.
Yeah.
And it's about a lot about comfort, a lot of the soft skills and stuff. But all these are very intangible stuff. How do you gauge from it? Or is it just a very gut feel thing that you're
It's obvious. Some of these criteria you can do a checkbox, right? You can
yeah?
put it on the Excel sheet and fill out the form. But you're right. Sometimes it's really just the gut feel. Like, do I trust him? Do I believe in him?
Yeah.
Fortunately for us as venture lenders, we take less of that risk in a sense, because a lot of times there are customers, there's a P&L, there's a financial model to look at already, right? Whereas our seed VCs, they really are very focused on that founder. Like,
Yeah.
do I think you have what it takes to build the next billion-dollar company?
Yeah. True. And of course on that point itself, talking about stages of company, I think the Anka from Spotify basically asking at what stage venture debt becomes viable for startup?
Generally, I'd say um, Series A, well, Series A and above. But I mean, at Genesis, we tend to look at Series B and beyond. But there will always be that one or two outstanding Series A companies that are fit for venture debt. I mean, there are some companies, even though they are so-called Series A, but they
Mm,
are like at 30 million revenue. They
mm,
are Series A only because this is their first institutional financing round.
yeah.
So, we really have to look at what it means by Series A. But the traditional Series A, as we all know, there are times we will look at it seriously.
Mm, understand. Do you do any, okay, so this is a question on David Ward. How does a young product-led company secure better financing for supply chain? So do you provide financing or supply chain? I don't think you do, right?
Well, in a sense, supply chain financing, it also relates to working capital. So it
Yeah,
depends on
true.
how you want to call it, right? But we are not super heavy on that. Even if we do it, it will be part of that larger venture debt financing structure. Yeah.
Yeah, understand. A very interesting question here from Chris. How transparent is the Singapore financing market, or will it come down to a few main players? And at the end of the day, SMEs and startups can't fulfill that. And I think that's one of the questions. How transparent is this space?
How
Uh,
transparent is this space? I'm not sure I get the question, but I think in Singapore, we are a financial services hub.
yeah,
I think if you are anything from an SME,
mm,
so-called the S or within the SME,
mm,
there are some government programs like the micro loans
yeah,
uh, that can help a company get started. Then venture debt would be on the other end, where it's really tailored for startups that have VC investors. But for the bootstrap startups, again, one has to realize that the company, with very little revenue, not enough vintage, loss making, it's really hard for any lender to extend uh, um, debt financing, because credit principles, right? So that really puts these companies in the equity risk realm, which
mm,
has to be funded by the family, friends, and fools category for now.
yeah, for now, until they grow to a certain extent.
Exactly.
And I think it's probably the same, I think there's a question from Massimo more related to his industry. I think he's in the food tech industry. I'm not wrong, he does crickets, cricket flour and everything. And
Right.
I think it's still in the very early days. So of course the question is alternative venture financing. Is this something for them?
I guess alternative venture financing for alternative protein startup. I guess, okay, again, it relates to stage of the company. I think
Yeah,
these days, I think the company is in the right space. Food security and cheaper forms of protein definitely high on the list.
yeah,
But again, if it is a startup, like, what stage is it? Do
mm,
they already have a product
yeah,
ready? Is it being
mhm,
sold or not? So we look for commercialized products,
yeah,
proven revenue streams, VC investors, again, is the same criteria that comes in.
Criteria at the end
Yeah,
of the day. So it's not sector, it's sector agnostic. By the end of the day, there are certain checkbox and things that you want
correct.
to get to pre-qualify.
That's
And
right.
there is a greater emphasis about revenue for now. Never say never, but for now, revenue is still a very important.
Well, I mean, not just revenue, right? Like, but quality of the revenue. So a company can have $10 million of revenue, but gross profit is minus 20%. That's not quality revenue.
True,
Yeah.
agree, agree. A question over here is, does actually alternative, financial debt impact valuation?
No, you'd be happy to know that we do not, and that's why a lot of founders like it, because we don't establish any valuation for the founders or the round. So for a founder that's looking to raise Series A, Series B, um, typically we come in and fill the round, but we don't dictate the valuation. It would almost always, it will always be the lead equity investor that would set the valuation.
Got it. Got it. Okay, I think I have a question here, a little bit less related to venture debt, but probably more of the ecosystem in general. They were saying that, what kinds of ventures are getting financing these days, in terms of fundraising and probably debt financing, and what alternate approaches or what people are doing differently during this period of time, when they are going out. Do you see activities level drop during this time?
Actually, no. I still see a lot of companies getting funded, a
Yep.
lot of deals being closed. In the early days, my VC friends would say, yeah, well, those were the deals that we looked at in December. We're just carrying over.
Yep.
But I think, humans, especially in the tech ecosystem, right? You talk about pivoting, fail fast. People
Mm-hmm.
have evolved, right? So talking about virtual due diligence, how else can I give you comfort that I'm a real company? Let's
Yep.
talk about it. Let's figure it out, right?
Yep.
So I think deal flow. While the numbers may suggest that the funding dollars have dropped, but I think if you dissect the numbers, it's still very strong, especially for that. If you talk about bell curve, the companies in the middle of the bell are still getting funded.
Yep.
So activity levels are there.
Mm.
If you read your TechCrunch E27, your Tech in Asia, you see that there are deals being done.
True. But of course, a lot of deals for some of them, especially the non-B2C ones, probably only announce it before the next fundraising, right?
Actually, interesting you say that, but like I think we've seen quite a wide range of deals being announced. Like
True.
there's not been any
I,
conclusion that like, hey, only B2B companies are getting funded in the last
no,
five
I
months.
think I think I agree with you because interestingly, during the COVID period, actually, there are offers going around. There are, kind of institutional activities going around. It usually brought up to two groups, right? One group of them that they still need the comfort of a fiscal, kind of meeting before they can deploy any capital. But I
Mhm.
think more and more VCs and investors are starting to be comfortable over the fact that, they are still able to, kind of do most of duty over the call and all. And I think one of the more important thing also is because they network way before that. So they might have known the founders for 1 year or 2 years before they
Correct.
deploy.
That's right.
Yeah.
So most VC friends that I know, they will never invest in a company they met last month. So there's
Exactly.
always this process about getting to know each other. And if you are a founder worth your salt, like the VC community kind of would have heard about you, or at least your product, or like heard about you from a friend of a friend. And I believe that's how you and I met as well, right? So there's
Exactly.
there's always some linkages. These
It,
days you cannot just show up
yeah,
and have, and no one knows about you, right? Like
yeah,
usually if you ask around, like there will be some, like, hey, he's a good guy, like we went to school together, or like we worked on something together before when we were both in banking,
yeah.
things like that.
It is a very small ecosystem at the end of the day. So, I think the point over here, I think for most of them here is for especially those who are still new in this fundraising space is to start networking and start
Oh,
knocking people.
absolutely.
That is what you need to do to get yourself, kind of at least you are familiar with people and people hear about you.
Correct.
Uh, but of course, do you expect more fundraising? This is actually a question over here. Do you expect more fundraising next year, or will the aftermath of COVID cause further dip in opportunity? So I think we both agree that I don't think there's going to be a dip coming up too much, right, on this run.
fundraising for the startup. So yeah, I believe there are still activities. So
Yeah. But
the
you expect
investments
more
will go
next
on.
year?
Sorry, do I expect
Expect
more?
more fundraising activities next year?
I think it's ongoing. As for the actual amount, whether it's more or less,
Mm.
really depends on whether there's a vaccine or not, whether people can travel or not, right? Like if all these green lanes are being established, hopefully we'll see an increase, right? Because today, if you are a B2B software company
Mm-hmm.
and you're fundraising, and your customers continue to use you, in fact they're using you more.
Yep.
I don't think this not being able to travel would impact that company's fundraising plans by too much. In fact, if this company is going out there raising funds because like my sales have grown 20% month on month for the last 5 months, I need the money.
Yep.
I'm sure there'll be the
People who
VCs will
might.
say, take my money,
Yeah,
right?
exactly. And that's why in this situation, right? When you're still growing well, you stand out even more.
Exactly.
Yep. And actually, it makes okay. So I think we left with about 3 minutes of the time. I think just two final questions. One, I think that's come from from Elite Linguistic itself. What is a very practical way of executing this? What's the next step for this? Yeah,
my
interesting.
my my usual background is this. Let me change my let me change my background.
Perfect.
Scan the QR code and get in touch.
Exactly. So I think if any one of you are in touch in the venture debt side, that is one of the area. Just having the conversation, having network, right?
Yeah, exactly. Like, I'm on LinkedIn. You can scan the QR code or get my contact details from Sam. More than happy to have a conversation. Even if you're a seed stage, just really helping a member of the ecosystem to understand the options available out there, right?
And I think one very important thing, just to share from my own experience itself is I've seen a lot of founders who are not doing what they're doing. They probably have restarted or they are already doing something very different from when they first started out.
Right.
So sometimes it's also not the ideas or anything yet, but also to kind of have that network and the comfort of what are the things to look out for, and then you kind of move along the way and navigate the ecosystem as well.
Yeah.
Yeah. And the final question over here is more of a bit of your competitors. Is Genesis the only venture debt provider in the concept you're doing?
No, no, no. There are other players there. But it is how I would say same but a bit different. So like you look at the three local banks, right? Like they all look the same, but actually, the way they approach lending or doing business is just slightly different. So I would say it's same but different.
True, true, true. So yeah, so I think with 1 minute left itself, any parting words for everyone, to really, any advice that you might have for them or any parting words when it comes to what you do?
Well, it's been an unprecedented time, right? With not being able to travel and a lot of unknowns. But I think now we are in August. A lot of the unknowns are known, but don't take things too lightly. That's why I say life with COVID. Really just remind yourself why you are doing this. Being entrepreneur, there will be times where it's difficult, very challenging. You question yourself, but you got to just keep on keeping on and remind yourself that you get to do this. Other people don't get to do this, but you get to do this. So hopefully that gives you a good reminder of why you're working so hard.
Yep, definitely. I think that is really one thing. It is, in any crisis, there's always opportunity, and also at the end of the day, it's an opportunity for us to navigate and to learn as well. I think a lot of times in startup ecosystems are about experimenting and also gaining the experience
Yeah,
because no other industries, I would say, very rare that you get this kind of all-rounder exposure.
yeah, I can tell you that. I came from banking before I started Genesis with my partners. I thought I knew something, right? But this entrepreneurship experience is really humbling, and you learn so much.
Yeah,
Yeah.
definitely. So yeah, so that I think was my last question, and it's probably about five. So if anyone wants to be in touch with Martin, the QR code is there, and And Martin, really thank you for this time. I think you have answered most of the questions that some of the participants has posted. Not everyone is on the call, but those who are not on the call, we will just kind of share with them the answers as well.
Fantastic. Thanks for
Yeah.
having me, Sam, and thank you everyone for spending this afternoon. I know there's a bit of webinar fatigue already, but hopefully we made good use of your 1 hour.